I ran across this tweet by Jesse Felder regarding the commercial loan portfolio in the U.S. Let's jump in and take a look. This year will be critical because about $270 billion, billion with a B, in commercial mortgages held by banks are set to expire. These commercial loans were written on 5-year recaptures. So that 5-year period is coming due, and those loans are going to have to be rewritten with the new guidelines in place and at the current interest rate. And so when I say guidelines, the guidelines that they were written to originally, the cap rates were lower and the lending criteria was a little bit looser. Well, now that liquidity's dried up in the market, the guidelines have tightened up. And so you have tighter guidelines and you have higher interest rates. And so now these properties that qualified for the debt 5 years ago when liquidity was abundant, rates were low, many of these properties will not qualify for the refinance. So what's going to happen to them? The critical part of this is that, and he points it out here, most of these loans are held by banks with less than $250 billion in assets. So is this a perfect storm like we saw back with the single-family loan portfolios in 2008? Let's remember what they did in 2008. They securitized them and they stacked them, and you had A paper, B paper, all the way down into D paper. And when those D paper loans, the ninja, no asset, no income qualifying, when those started to fail, well, it acted as a contagion to the entire market, and that's really what led to the meltdown. So let's hope that doesn't happen here to the $270 billion. But at the end of the day, the banks need to come up with a solution for how they're going to refinance this debt. Some people say that private equity is ready to do it on the sidelines, but private equity, they still want the properties to qualify. So something to think about, guys. If you like this content, give me a thumbs up, share it with your friends. I'll catch you on the next video. Thank you.